Hello, hello, Oak Bloke here. This is going to be covering Begbie Traynor. So I covered this. I covered this a year ago, and kind of quite liked it really, and looked at it again today, and yeah, well, yesterday and today, and still liked it, I guess. So in my original article, which is this one here, so if we click into here, we get to the original article. In my original article, Choose Life, Choose an Investment. I guess that just quickly sort of recap where this was back in October 2024, so about a year, just over a year ago. I sort of said, surprised to see it trading at just 85p. Seems jolly cheap to me, um, which proved to be correct because from here at 85p 12 months ago, well, you could have made about 50%. I think I didn't quite make 50, but I sort of sold out somewhere sort of about here, I think, after this little vertical thing to about 120, and so I didn't quite hit the top, but now it's sort of come back from 125 to 110. Um, it looks good. It looks good to me. And my thesis, I suppose my original thesis when I looked at this a year ago was that it was making double-digit growth in revenue, double-digit growth in profits, that it had that sort of slightly counter cyclical element to it. And um, I did point out the, the the aspect of adjustments. So adjusted, do not adjust your set. We'll be coming back to that word again and again. And I guess the thing that you've got to feel happy about with this is that it's done a lot of acquisitions. You can see there 13 acquisitions in 4 years. That's 2/3 of revenue growth. Organic growth is 33%, so it's 7% growth compounded. And I said that's pretty good. As in the organic growth was 7%. Just to be clear on that, so that's pretty good. Uh, and then I sort of looked at the different acquisitions and tried to. I mean, basically, I sort of thought to myself, well, there's two explanations here. Either they're out there going making all these acquisitions, throwing the cards up in the air, creating a load of smoke and mirrors, and behind it all, they are kind of not really getting anywhere. They're just spending a lot of money on acquisitions, wasting their time. And eventually, like a snake eating its tail, eventually that whole process of making acquisitions and your profits are depressed because you're growing and you're expanding. I guess that catches up on you. I mean, I've written about or spoken about this with, say, for example, with water intelligence, where yes, they're making acquisitions, but then what they're acquiring, there's no growth. So you're sort of losing the 6% or 6.75, I think they earn in terms of fees from the franchise fees. So you lose your franchise fees and you gain direct margin. But then if you're sort of not making more money than you did before, then what's the point? You've just spent a load of money on buying these acquisitions. You might as well have just given the money back to shareholders for a start. What's the point of growing something that's not growing? Seems obvious, doesn't it? But yeah, as I say, because it can all be dressed up into this strategic direction and strategic words that include the word strategy, that you can kind of end up not really, well, I suppose eventually you sort of get fed up with it and you sell it, get rid of it. But you might spend years and years just wandering through the wilderness, hoping that things improve, or you might buy it, it might go down, and then you're sat there waiting for the price to recover, but it never does. So I guess the thing with this a year ago, and I don't want to spend too much time on a year ago because obviously it's a year later, But I kind of looked at it and looked at the growth, and I said to myself, well, it's not just about acquired growth, it's about organic growth. But equally, when you sort of look at the price they're paying for the acquisitions, when you look at um, the cost it would cost to grow the business instead of acquiring, because that was the other thing I did. Now, rightly or wrongly, and I think £20,000 per fee earner is very much on the low side. I mean, you could double, maybe even triple that figure, I think, to take somebody from being out of college to being a senior fee earner. I mean, it's decades of experience, as well as all the training and qualifications and professional exams. I mean, it's not a straightforward process. Um, there's continual learning. So the point is, if you acquire a business where you've got, I don't know, say two senior partners, each with 20 years experience, um, you're shortcutting that organic growth and recruiting the college graduates, combined with recruiting senior fee earners that you can tempt away from other firms. Tempting them away requires to pay them more. Um, Buying the firm they work for doesn't require paying them more. If you sort of see what I mean, that especially where you've got business owners that are looking to exit the business as well. I mean, they're heading to retirement, things like that, whatever reason there might be, or that they themselves, the owner of the business, you offer them some sort of incentive scheme or whatever. Come on board and we'll give you this, we'll give you that. He may well, or she may well, uh, take that offer. That might be an attractive offer. Be part of a bigger organization where you've got less stress, all of the overheads and all of the admins being done for you. You don't have to do your tax return anymore. You don't have to worry about a lot of things when you're no longer self-employed and you're employed. So it's kind of a good strategy, in principle. As I say, I won't dwell too much on what I covered last time. Well, actually, I'll just quickly mention this though. Yeah, so this was sort of when I sort of said to myself, well, when you sort of work out how much it would cost to sort of not acquire, um, and when you look at the increase of profit per person, I mean per fee earner, that was the thing as well. I mean, if you're taking on more and more and more fee earners, and your average earning per fee earner is going down, or your operating profit is going down, again, like, what's the point? You might as well just stay the size you are and just return all the rest of the money to the shareholders, because you're wasting your time by growing it because you're shrinking the profit. And obviously that can sometimes be, you've got to make a bit of a value judgment there, that you could have some short-term pain for long-term gain. And again, you've got to sort of decide on that. But in this case, I mean, they were expanding, and profit was at least staying steady per person, per fee earner. And for me, that was the real thing that I liked about this. And as you can see here, I mean, when you look at it from an operating profit, or from an adjusted profit point of view, or from a profit per fee earner, you can see here, 2021 to 2024, 47 to 56 per fee earner. And some of that, to be fair, I mean, if you kind of look above these numbers, it's because you're growing the business and you're sweating these poor support people harder and harder. In other words, you take on a business, say that, say they take, I don't know, they've got 20 people and two support people. Well, so sorry, but the two support people, see you later, here's your redundancy. They take on the 18 fee earners, let's say, and then to the 150 odd, 152 fee earners. Well, you can sort of see the numbers here. I mean, they've grown the fee earners here and here by what, 50 and another 50, so by about 100, and they've increased the support people by 3. So that's how you do this, is that well, you can sort of see it here, that your cost here is going up by what, 1 million, eighth of a million, and 1.2 million. But here your profits are going up by 6, 7 million, 3, 4 million, 1, 2, 3 million. So you're growing your top line profits without sort of by sweating these people harder. But also, more than that, automating what those support people are doing. I mean, they've put in a CRM system, they've put in different systems and automations. Credit control, probably things like this. So, rather than having an army of people pushing paper and phoning people and saying, "Hey, you're overdue on your bills," you just set, credit control automation software that will do that stuff, and then you don't need an army of people. You need one person who's being fed all the exceptions from the credit control software, um, and do it in a smarter way, and just automate the rest of it. To automate the sending of personalized emails is pretty much par for the course of credit control software nowadays. So, yeah. So look, as I say, I don't want to dwell too much on the past article, but when you look at the fee earners, profits, that was always one thing that stood out in my mind. And I guess that was it. So I suppose when I came to write this second article, I thought, well, have I got anything new or original to say? Uh, Maybe not. I mean, maybe it will be a regurgitate and a cut and paste jobby. Things are a year later. I'll add a 2025 column and sort of republish the article. I don't often do that, by the way. I mean, it's usually a bit more. There's a bit more to it than that. Um, but I want to sort of start there to kind of set the scene and say, well, is it, or was it? So, I mean, I have pulled a few, sort of odd bits from the original article. I thought keeping this fictional character anyway, there's a little bit of fun involved in the play on the name, but anyway, that's by the by. So yeah, anyway, just kind of a couple of other things I suppose I spotted and noticed that I've added to this article. First of all, to kind of look at their geography. I mean, they've got a very, very wide range of geography, but I mean, at the same time, you can see there's big gaps. I mean, I guess you could sort of say, well, like this is all rural whatnots. Maybe some of this is rural whatnots and mountains, and nobody lives there except sheep or very few people. Maybe some of this, maybe some down here, and maybe some over here. So you can kind of get that where they've centered their offices is kind of population centers. But having said that, I mean, there's a whole chunk of Middle England that seems to be, um, you know, opportunity for expansion. There's obviously some places in Scotland that you could. So I suppose I couldn't help do a similar to what I did at Greg's, to kind of think, well, if they expanded, if they acquired a firm in, I don't know, Norwich or somewhere like that, that what would there be further expansion? The answer, of course, is yes, absolutely yes. And also, just I suppose thinking about the verticals that they're involved in. I mean, these are obviously the eight sort of verticals which come under two divisions. So you have the property division, and then you have the business advisory or business restructuring uh, division, and within that they then have deal advisory, restructuring, financial advisory, funding as part of the one segment. And then I guess this is the property segment down here. So you've got sort of, these are the top section is the one business, the bottom section is the other business. But you could imagine there's other sub verticals that they could expand into. So it's not just about expanding geographically, but also expanding the service breadth, um, and maybe even specialisms within. I don't know this area of professional services well enough to comment further, but yeah, certainly it sort of looks broad, but with the capability of expansion, or further expansion. Um, so am I still bullish? Well, yes. It's gone up since I last looked at it. So obviously it's always hard when you look at something and you say, well, I only paid 85p for it a year ago. So Do I really want to pay another 25p? I mean, on top of the 85p, that's 30% more than I paid before. Am I sure I want to pay an extra 30%? And of course, sometimes the answer is, well, yes. But that's the bit that's sort of running through my head and possibly yours when you look at shares that have gone up, that it's harder to buy the ones that have gone up rather than the ones that have gone down. Psychologically, it feels harder. But of course, we've got to be disciplined and we've got to look at things in relation to where are they? What am I buying for my 109p? And compared to what I paid for 85p a year ago, if I paid for something that was smaller and less profitable a year ago, and I'm now paying an extra 30p or an extra um, what would it be, 34p, an extra 34p, um, but I am getting, no, sorry, 24p even. Sorry, I'm getting my maths. I'm getting X, Y, and Z extra. So it's a case of looking, and also what do the forward prospects look like? Where's it going to go from here? Um, so it was reviewed and it was given an amber, and the profitability was consistently low, which I kind of thought, oh, really? Okay. And I sort of looked at the and the market was underwhelmed. Well, the market wasn't underwhelmed because it shot up 25% shortly after the review, and so yeah, obviously making claims about the market thinks this, the market thinks that. Well, the market will think what it thinks, and so yes, it went up to 125, dropped back to 110 or 109. So yeah, there's I suppose a recent example where there's potentially 10% upside before you even get going, if you believe that 125 was a reasonable number for it to go to. And I suppose this thing about the profits are consistently low. Well, if you look at the latest profits, latest profits are not consistently low; they're doubled. So I mean, this is the PBT, but the PBT doubled. The comprehensive income, so profit after tax, quadrupled. So I think let's just get that out of the way. Oh, sorry, my head's in the way. Let's move that up. There we go. 1.5 to 6.3. Yeah, I mean it's not consistently low. Quadrupling of profit is not consistently low. That's inconsistent. So I suppose I make the point about that. I then go on to look at the valuation metrics that we use to sort of say that this is consistently low. And when you look at these numbers that were 3%, pretty awful actually. I mean, why would you want to invest in a business that's only earning 3.1% return on equity? Uh, so I thought, wow, I don't have a response to that. To kind of the fact it's only earning 3.1% return on equity. Um, uh, well, and also the operating margin, 6.5%. 6.5%. I thought that's really low. But then I thought about my past article and I thought, well, these fee earners are earning about £40,000 operating profit each. How on earth is it a 6.5% operating? It just something clicked in my head. I was like, well, that doesn't seem right. Anyway, I kind of looked up the same numbers. So that was kind of what it was in the article. I looked up the same numbers. The numbers were very different, even though I looked them up, and it's based on the same numbers. There was a trading update numbers, and then I'm looking at the annual report numbers, but it's the same full year numbers, but they'd magically changed. Anyway, I looked at again operating margin 9%. I said, is it 9%, 9.04%? Again, just seems very low. I did my own calculation. Well, and it was less. It was not 9%, it was 7.5%. But that's based upon the operating profit being 11.5%, the revenue being that, operating margin is that. And I tried to work out how they've arrived at 9%. Can't I can't work it out, but maybe there's a solution to that. I mean, that number tallied. return on equity, net profit is that, the equity is that, the return on equity is that. But that number is more, well, almost triple the original article where it was consistently low. So the the actual numbers that you're working from are not consistent. So that seems to be the problem. Capital employed, adjusted profit, return on capital employed, 16.6% is obviously uh, uh, different to the 13.2 as well. And again, I couldn't work out why that one was that, not that. Anyway, be it as it may, I suppose then I started to think, well, okay, there's some potential here. Where when you're making 16.6% return on capital, return on equity 8%, operating margin 7.5%, and bearing in mind that these are, like, I mean, we got to return to that dreadful word adjusted profit and look at that and understand that a bit more. And I suppose when I sort of said, well, is this a cut and paste? I thought, you know what, I've got to kind of get into that adjusted again and really get my head around it again and dissect it a lot more to understand whether the adjusted is kind of, you know, is it going to be adjusted forever? Is this adjusted going to drop away? Is it going to fade away? That's kind of what was going through my head. Anyway, yeah. So since that full year accounts, uh, BEG have released a trading statement in September with no new numbers, so they're not sort of publishing any different numbers. That doesn't explain the difference of the numbers, but they have in their trading update said there is encouraging activity levels and momentum, organic development and growth expected in the period now from. So they released the update in October. So they said in the period to April we're expecting stronger growth. So it's this statement here. So we're confident in delivering market expectations. So my next thought was, well, what are they? So the market expectations is that they're going to grow revenue by 10 million and they're going to grow PBT. Bearing in mind, PBT is the non-adjusted PBT. Oh, sorry, no, sorry, it is the adjusted PBT. They're going to grow that by between 0.2 and 1.4 compared to FY25. So I said, okay, PBT was 22. I think it was 23.5, sorry, 23.5 in the current year. So they're either going to grow it by 0.2 or 1.4. But that's obviously a quite a nice number. And then I suppose the next thing I was looking at was they release a quarterly publication called the Red Flag, which I make the point it's nothing to do, presumably nothing to do with politics. But they instead speak of businesses that are in critical condition, businesses that have significant difficulty, and how those numbers are up very sharply, and particularly hotels, restaurants, businesses affected by the national insurance tax rise. So Rachel Reeves, who wants economic growth, um, isn't going to get economic growth when the number of businesses that are facing bankruptcy and devastation is up 21%, and the ones in difficulty are up nearly 11%. So that's pretty damning indictment on the effect of sticking to the election promises but sneaking through the tax on an element where they didn't make a promise, but effectively it's still a tax on employees, so it's still a tax on people. And employers NI was seen as the I suppose the soft underbelly, which in World War II, Italy was seen as the soft underbelly, and it proved to be a thorny, difficult. I think I can't remember how it was described, but it wasn't. It turned to not be the soft underbelly that Churchill foresaw. Excuse me. And taxes could go up next month in the budget, so things could get worse, not better. I mean, I don't say this as a political statement. I couldn't care less about politics. I've got no interest whatsoever in. If anyone wants to talk about politics, please go and do that somewhere else. I'm not interested. But I mean, I'm interested in how it affects, I suppose, my investments and what that means for those. So as far as I'm concerned, I suppose for those of you who, I suppose, like me, whilst you feel optimistic about certain companies and their ability to navigate through these difficult times, and the difficult times have been difficult for a long time. I mean, and that's a challenge. But I suppose the thing about Begbies is that it's counter-cyclical, that when the number of businesses going bankrupt prospectively are going to rise by 20%, or at least these that are in critical condition. I mean, these are your next customers potentially. That I suppose, yeah, it's kind of betting on the vultures when there's some people entering the desert that look quite thirsty. So not pleasant, but yeah, vultures have to eat too. And not that I'm calling them vultures. I mean, when businesses get into difficulty, somebody's got to go in and, you know, like try and sort it out, recover it. If they can, they can. If they can't, they can't. If they can't, then, you've got then the responsibility back to the creditors, back to the tax uh, uh, lady. I was about to say the tax man, but technically it's Rachel Reeves, so it'll be the tax lady. And tax person, I think I should be saying. Uh, and yeah, you can see it here: bars and restaurants up 41, so in critical condition. Travel and tourism up 39. I mean, that's terrible as well. Travel and tourism up 39%. Like, you would have thought post COVID, everybody was sort of, revenge tourism was a thing. I'm really surprised that tourism is as bad as that, because you would have thought that tourism would have actually been quite buoyant. But anyway, yeah, I don't invest in anything tourist related. I never have, probably never will. So I guess I don't know that much about tourism. But you would have thought. I mean, it surprises me that they are the sort of second worst vertical for critical condition, for critical financial distress. General retailers, and then you've obviously got. I mean, that's an astonishing number, isn't it? In significant distress, 666,000 businesses. That's just. I mean, it's potentially devastating. Anyway, I don't want to dwell on it, but it I mean, surely somebody that, is in government that reads that just sort of says, "Hey, like, we've got to do something we've got to do something about this, because this could sort of send unemployment up into the millions, or up further by millions, if a load of businesses, because the other thing you've got to think about is the whole domino effect. I mean, like I say, business recovery is about protecting creditors. I mean, a lot of the time, the creditors will be other small businesses that they themselves might also be in significant financial distress. So, whilst you could sort of talk negatively about vultures, and I just did, there is that flip side of saying, well, like, you've got to just sort it out and move on, because once a business has folded, well, the best thing you can do is just sort it out, square it away, move on. And it's the uncertainty, it's things getting protractedly dragged out over months and years, and having, sort of, if you can kind of get creditors paid, and so on. I mean, that's good for the economy. That is good for the economy. Anyway, I don't mean to turn this into a soapbox. Uh, I suppose it's just to say, that's a bit more of the background behind this share. That, I mean, obviously the property side is completely different, and that's sort of managing property and property transactions. I mean, you sort of see the list here that property agency, public sector property, transport planning and design, vacant property services, asset advisory, restructuring and recovery, lease. I suppose there is a bit of recovery there. I suppose property auctions and so on. So various services. Anyway, let's let's move on to I suppose the core of this, which is, so I've rerun the numbers, including 2025. Um, and yeah, I mean, you can see here there is a slight reduction on the property side of profit per fee earner, but a rise at the business recovery and advisory part of the business. And these are very, very good numbers. I mean, I suppose, there's more of the BRNA. They're topping out at, I think it's 43.8, something like that. And then these guys are at about 20, as you can see there. So, average probably about 30,000. And this is operating profit. So this is beyond their wages, beyond the support person, beyond all of the direct cost of sale, beyond, this is sort of operating profit to the business. So in other words, as they have added more and more and more fee advisors, so fee earners rather, that the profit per person has not been reducing. I mean, it's not going up kind of massively fast either, but then I'm not necessarily looking for that to happen straight away. I'm looking for at least to see some growth at a unit price level, at a unit level. But then because we're adding more, or because they are adding more, that's where the profit comes from. That's what, that's where you get the leverage, is on the volume, not on the unit price. And I suppose the point about the unit price is that this, uh, at least, because I mean, the other thing to say is in these 5 years, you've had inflation, you've had supply chain shocks, you've had, energy costs. Like, there's been a lot of reasons why these profits could have gone down, and they haven't gone down. In other words, they've increased their prices to keep pace of and absorb, cost rises. And these are sort of high earners. These are not minimum wage people. Fee earners are going to be well paid professionals that are, you know, making good salaries and bonuses and different things, and rightly so, because they're specialists and good at what they do. And you're not sort of I don't imagine they're getting away with doing things like, saying, oh well, sorry, we're not going to give you a pay rise this year, um, because they would go to another firm. Like, professionals have choices, don't they? Anyway, so I think that, for me, I mean, no, it's not increasing rapidly or anything like that, but I'm happy with that personally. And those sort of profit levels, as I say, post cost, is excellent. They added 51 more fee earners, and sorry, 51 more of the blue ones, 64 more of the red ones. So we see operating profit has increased by 2 million. And they also tell us that 43% of that growth, that 2 million, is organic, 57% is acquisition related. So what we see, and these are the numbers from that chart, is the operating profit. I mean, we can see that is growing each year. So that's really good to see. As I say, when we see the continuation of the shared, I mean, the shared has gone up by 1 million. Property's gone up by just a touch. This has gone up by 3 million. Okay, operating profit. So this is the one. Now, bearing in mind, though, you can sort of see it here that this jumped by 2.1 million, which, when you look sort of here, this is sort of like, this was above average. This was sort of exceptionally high, as opposed to, so actually the fact that, again, it's sort of remained above the fact it's slowed down, for me, is not a negative, because it made such a jump here. I mean, you look at that compared to that, that's what, 10%, and then that's 50%, or maybe not 50, 40%. So, for it to go from 10 to 50, sorry, 10 to 40, and then not to go up by another 40, like, come on, like, this is the real world, we live in. It's not going to go by 40 every year, but it's gone in the positive direction. So operating profit is up. Finance costs are up, but then, they're not huge. I mean, obviously that's sort of quite a small proportion. Um, and obviously that will get paid down as they generate cash. So again, I'm not too worried about this increasing. But yeah, what I see is a really, really strong picture of growing profits and growing profitability. Like for me, the consistency is not consistent low profits, it's consistent profits. Now, this is the bit where we're going to get to the adjusted bit, because this is the bit that I think is quite confusing. So, so the acquisitions of the past 5 years are contributing 6 million of operating profit, and that's in rough terms about a 16% operating margin. That's kind of where I was getting my 16% from. Was that, and as I say here, despite inflation, Rachel's new taxes, the profit per employee is consistent, and that's the bit that I'm happy about. So if we move on to this chart, what we're seeing here is I've worked out, and I've done this based upon the growth of revenue. So the growth of revenue relates to the growth of profit. That's the assumption I'm making. If they're making more revenue organically or making more revenue via acquisition, then I'm saying the profit growth is following that. Now, I don't know that definitively, but it's a reasonable assumption to be making. So that's kind of why I'm getting this 57% is acquisition, 17% is acquisition. I've looked at the relative growth, okay, of acquisition and organic to get to these numbers. So what I see when I look at these numbers is the profit via acquisition is growing. Of course, here a year ago when I looked at this, I did sort of say like, oh, this 0.35, it is growing, but it's not growing by a vast amount. But then we were told, cast my mind back, but I think we were told that they had to sort of do sort of synergies and realize synergies and sort of that work was ongoing. So the fact that we see this tripling year on year, and obviously it's not as high as this value here, but much higher than the two preceding years. That's very, very pleasing to see. So we can see, the stuff that's coming through on acquisition is also now generating profits for post acquisition. Very like sometimes when you make an acquisition, the company you've acquired just goes to pot, and you get anergy, not synergy. So a negative synergy is an anergy. Uh, it's not happening here. We're seeing synergy, but we're also seeing organic profits growth as well. And again, we can sort of see it slowing. Um, but these are just deltas in the adjusted profit. So and obviously a lot of this would depend upon the quantity and number of people that are coming on board organically and via acquisition. If more fee earners are coming in through acquisition, then that's why this number would be higher and that number would be low. Bearing in mind, this is the growth. This isn't the absolute amount of profit. This is the growth of the profit. This is the growth of the profit. Anyway, profit delta is 29 million, and that's essentially like they made one very small acquisition in the past year. So the total cost of acquisitions is 36 million. The total profit delta is 29 million. So you can kind of see for yourself. I mean, the return on investment of taking on acquisitions is fantastic. Like it's, as I say, it's a synergy, not an energy, and you can see that in the numbers. Those are those are the same numbers that we've just been talking about, operating profit per employee. Anyway, yeah, so they've made as I say, a number of acquisitions over the years, and yeah, so like this I think was very, very good to see as well, that within the revenue that 11% organic growth within that segment. Obviously here this is lower, so in other words 8% was acquisition based growth, and only half of it was organic. But here we're seeing it's pretty much all organic growth, which is really good to see. In other words, that's that we're seeing the benefit of the investment they're doing back into their own people. Okay, moving on, invest in organic growth. So yeah, I mean, this is the same point I made in the original article, that if you sort of assume 20k of training, and I don't know that that's the cost. I suspect that that's very, very, very much on the low side. I think you could potentially double that and say it's 40k, not 20k. Plus, it's not just the explicit cost of the training; it's all of the sort of lost productivity when you've got people who are new to a job or less experienced and not senior. Um, so, like at a minimum, these numbers here get you to about 10 million quid. In other words, they've spent 36.5 million, yeah, but they would have spent 10 million just organically growing the same number of people if they could find them. Because that's the other thing. Can you find the right people organically? It's not always that easy in tight markets to find good people that have the qualifications, that have that will come on board at a reasonable price. So so 10 million of 36 million, but that could potentially, I mean, you could argue that one to be 20 of 36. The costs would otherwise have been 20 million. So spending 36 to save 10, possibly 20, but then to get profit return on investment as well, it's a no-brainer. It's a no-brainer as far as that goes. So I won't sort of say much more on that. Yeah, I mean, one of the other criticisms that's been levelled at BEG is like the profits are too adjusted. Um, oh, no, I don't like Begbie Traynor because the profits are far too adjusted. What does that even mean? Anyway, I won't. Like, to me, it's just a case. Well, we need to understand what the adjustments are. Like, it might be a bad thing, it might be a good thing. We just need to understand what the adjustments are. Um, so look, the adjustments. I mean, this 36 and a half. Okay, 24 has been paid. So 24.3 has left the building. Okay, um, there's 7.5. I would say off the books. So off the books means if you go and look at the balance sheet, it ain't there. These are sort of potential unearned, like unearned fees, or they sort of say that there's sort of potential to pay 7.5, but it's not sort of sat there as a liability, as a creditor, whereas 4.7 is in the balance sheet, okay, as a liability, and that's that 4.7 there. So what I'm doing is I'm saying the anticipated future liability based on current financial performance is 7.5 million. But if you go and look for that 7.5 million, it ain't on the balance sheet. That one is, okay, because it's been recognized. That one isn't, because it's not been recognized. So, but that doesn't mean, like, as far as I'm concerned, how much did we pay for those acquisitions? Well, I mean, okay, we've paid, as in the cash that has left the building 24. We owe 4.7, so that takes us to 30 million. But as far as I'm concerned, oh, actually, I've just realised there's a million. There we go. My bad. Um, yeah. Oh no, actually, no. I am right. Sorry. Apologies. Yeah. That plus that would take me to 29. There we go. 29 million plus the 7.5 gets me to the 36.5. Yeah. Anyway, good to double check these things. Anyway, that's kind of, that's what's been paid. But then we've also got this, where we've got 5.6, which is paid but capitalized. So what I mean by that is that here under this bit by here, amortization during the year. Paid but capitalized. So paid, as in sort of, I suppose I should be saying there. Well, I mean amortized. Um, I suppose amortized from capitalized as an asset. Uh, so it was sat there as an asset on the balance sheet, but it's then sorry. Well, it would have sat here on the balance sheet, but it's been amortized during the year, which basically means to reduce it. Okay, so that goes to the P&L. So part of the adjustment is the cost of this acquisition. So it's part of that 36 million. And I suppose the thing you've got to sort of say to yourself is, well, like, I bought that business 4 or 5 years ago, or 4 years. No, sorry. Okay, start again. Sorry. The way that they have to amortize, you'll notice that like that is 48 and that is 42, and the amortization is, what was it, 5.6 of the so that balance there was about 15. So they're sort of having to recognize about sort of a third to a half of the, or it's about a third maybe, of the remaining amortization. So it's like 33%. So I suppose the thing you've got to understand is that the rules are that they've got to, when they buy a business, they've got to amortize it very aggressively. In other words, if I was buying a machine and, for my factory, and I say, oh, well, this machine has a 20-year life, or I buy a car for my business and I reckon that car's got a 5-year life. Yeah. I would amortize or depreciate it by 20%, or in the machine that's 20 years, I'd depreciate it by 5%. In other words, um, I don't know, £1 million machine, it would cost me 50,000 a year for 20 years in terms of depreciation. If I spend £1 million buying a business, I've got to recognize 333,000 of cost every year for 3 years, and then basically the value of that acquisition is zero. Now, you might take a view on whether that's a fair way of doing it, because, the business you've bought, is it only going to be sort of valuable for 3 years? Like, is its value zero by year three? You could argue that that's not the case, but that's what's happening. And that's the bit that you've got to be happy about with the adjustment, is that you're you're sort of ignoring the fact that you're being asked to sort of write off the value of what you're acquiring very, very rapidly. And it's, some of it gets written off very, very rapidly. Other parts of it get written off even faster. So what we see, I mean, and this is kind of the point that I make, is that it's this sort of very rapid shelf life for the amortization. Um, but then what you've also got further than that is that, so yeah, you've got to sort of say, like, well, if we look at the profit per fee earner, if that was dropping away after year three, it'd be like, well, fair enough. Like, I don't know, these fee earners get fed up after a couple of years of working for BEG. They're no longer productive, or they, whatever. They you know they go and leave us and go to another company, and we lose them anyway, so we've wasted our time, wasted our money. So that's what you'd expect to see if that was happening, but it's not happening. Or at least it's not happening in sufficient numbers. So I sort of fundamentally say to myself, well, that's hidden value, the fact that there's these assets that I'm buying that are not sort of running out the door, as far as I can tell, because the number of fee earners is going up, not going down, and the profits that they're making is consistent, not dropping, and the number of fee earners is rising, so I'm making more profit, not less. In other words, this argument that in year four, like, these fee earners that you're acquiring for millions of pounds are now sort of suddenly worthless is just garbage. But those are the accounting rules. So you've just got to sort of say, well, from a sort of underlying, and this is the point, it's like the underlying profit is what it is. And the next thing I'm going to say is, well, the other thing that you've just got to sort of think about, and feel happy about, is, well, because these are aggressive costs happening now, like, if you hang on for a year or a couple of years, what happens then? And the answer is that that yeah, I mean, this is sort of the adjustment analysis. So these are the total adjustments that have happened over the past 4 years. So I did 2022 to 2025, and you'll see that the adjustments were 13.8. They're now 11.5. I mean, in 2024 was 16.2. So they, and what sort of talk about next is there's four different types of adjustment. And I wanted to kind of go through these to explain them so that, and I'll do this quickly because I appreciate we're at 49 minutes and I try and, whilst I talk a lot, I try and keep it to an hour. Otherwise, who's going to watch something over an hour? I mean, nobody, surely. But transaction costs, I mean, these are basically like these. I mean, I sort of explain them in the article anyway. These are basically businesses that have been sold where the previous owners are still providing services or still have sort of like earnouts where, I don't know, in 5 years' time, if the business you're selling to us has contributed X million of profit, we'll give you an extra tickle. So these are obviously extra tickles and large extra tickles, substantial amounts of money. You'll notice that the transaction costs were large here and here, very small here, and nothing here. In other words, these are sort of tail ends of past acquisitions from years ago. In fact, what I do down here is I sort of explain where they've actually come from. So, businesses that were acquired, multiple bolt-ons of Edison's that were acquired between 2014 and 2020 that had earn-out periods of 2 to 3 years. That's kind of like where these 8 millions and so on are coming from. uh, they're not going to happen again. They're finished. I don't know, whoever the owners were of these businesses, they've had their cash. See you later. End of transaction. There's no more adjustments for. Not to say that there's not any for future ones, but we sort of capture those with this number back here. Sorry, this number here, this 7.5, this future liability. So we already know that this is already sort of like, this is the bit where I'm saying it's costing you 36 and a half, including that 7.5 that will happen at some point. The bit that's off the books, uh, these were off the books as well. And then suddenly they weren't off the books, they were on the books because they got recognized because, you know, 5 year performance. Oh, yeah, we've made X number of millions. Here's your extra tickle. Okay. But until you've got to give somebody that tickle, you're not going to put it on the books. Those are the rules. So again, there's potentially 7.5 based upon what they know. The next one, amortizations intangible arising, gobbledygook. Let's basically break that down. Those are those aggressive, 3 year, 2 to 3 year amortizations that are going on. Okay, 5.5, 6, 5, 3. So you can sort of see it's dropping here. If I go down here, these are the remaining. These are the remaining. So back here, the assets that were there that were going to be written off stood at 25. Here, after further acquisitions, it was 34. It dropped to 25. It's dropped to 15. So there's 14.8. Okay, so this 3.5 we see here, there's potential for another 14.8 on top of that. Okay, but once those have fed through from the balance sheet to the profit and loss, they're gone. Yeah, okay. And these are adjusted profits as well. So these are sort of like deferred costs, I guess you could call them, that they're sort of sat on the balance sheet to be recognized. Acquisition consideration, okay, the third one. I said to you that there was an aggressive 2 to 3 years. If you buy a machine, you can sort of depreciate it over 20 years or something like that, or a car over 5. When you buy a business, no, sorry, you can't do that. You've got to aggressively amortize it. It gets worse. This third one, acquisition consideration, because of IFRS 3, you can't even amortize it. You cannot even put it on the balance sheet. Sorry, that's got to go in the current year. The year you buy that business is the year you pay for that business. So that's like saying, I'm going to buy that £1 million machine. Bang, my profits have just gone down by 1 million. Even though that machine's going to last me for 20 years, sorry, that's the rules. I mean, again, you can take your own view on this, but my view on that is, well, that's ridiculous. And yes, definitely I want to use the adjusted profit, not the statutory profit, because that statutory profit is understating what the true profit is. The true profit is the adjusted profit, and it's very clear in my mind that that's the case. Finally, the final one is negative goodwill, and negative goodwill makes you think that it's going to be on the balance sheet, but it isn't. Negative goodwill is like an income code. So basically, if you buy a business where you get, it's what the Americans call a gain on bargain purchase, you basically book it as income. So when you pay an acquisition consideration, basically some of that can then sort of offset to be also to be income, and it's all to do with how you like you pay all this acquisition consideration, you get fair value of assets, and any difference has to be accounted for as negative goodwill, which is an income. So you've got a cost, you've got an income, so it's kind of like an offset. The point about this, though, is, and I'll come on to this next, is tax. So you do get stung because one of the other things that I suppose I didn't spot last time that I've spotted this time and went, whoa, was that when you engage in lots of acquisitions that involve adjustments, well, watch out, because the tax man is not taxing you on your statutory profit. Yeah. So the statutory profit quadrupled, the tax didn't quadruple. Uh, what the tax man is doing is basically saying, well, what's your adjusted profit? I'm going to tax you on that. So the tax in 2025 was 45%, and it is there in the accounts. I mean, it's there under, I can't remember where, but under one of the notes. The effective tax rate was 45%. The year before, the effective tax rate was 72%. Now, this is all because of the adjustments you're doing. And if you carry on acquiring businesses, then you'll continue to pay silly amounts of tax to the tax man, because those are the rules. And I suppose this is part of the equation, that when they're acquiring businesses, they're sort of saying, well, you know, we're going to get stung by the tax man and we're going to pay 36.5 million, but we're going to acquire all these highly skilled senior fee earners that have 20, 10, 20, 30 years experience, blah, 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 blah. Like compare that to doing a graduate program or trying to recruit, take employees from existing competitors. Let's just buy the competitors. So it's all part of this whole equation of kind of, but this is why I'm saying you've like, to my mind, and I'm going to finish the article here because we're at 56 minutes, but you know, you've got to almost sort of say, do you know what? The adjusted profit, but then take 25% from the adjusted profit to say, well, look, in the normal world, you would be taxed 25% corporation tax, nothing more. And actually, this is sort of interesting, that if you look at statutory net profit, okay, after, which is obviously after tax, compare it to statutory profit before tax. I mean, you can sort of see, like here, the profit was nil. But the actual profit was sort of 4 million, or sorry, profit before tax was 4 million, but the taxman took 4 million, so the business made a slight loss. Here the business made 3 million, but was taxed 66% here. Like the difference between zero, the size of this from here to here is what, like less than half of the size from here to here. And you can see here, like, nearly 17.5 million reduced down to 6, so was it 2/3 tax? So it's very, very noticeable, very, very noticeable when you notice it, I guess. Anyway, when I when I do that calculation and I say, well, okay, let's consider what underlying profit, taking off some imaginary tax level, okay, which is this red line here. And for me, this is the real key part of this whole presentation, is that profits rise from what, 13 million up to about 17 million, and that the cash generation is rising even faster. So look, to conclude, yeah, it's growing by about 10% a year, potentially could grow a bit more. I would say, is it, I mean, it's at 10 times earnings. Could it grow to 15? Yes, I think probably it could. It's at 176 market cap, underlying profit, based upon that calculation that I'm doing there, is that I'm sort of saying it's on an adjusted 10 times earnings. The statutory, it's not on 10 times, it's on 30 times or something on statutory. But I think you've just got to ignore the statutory and say, like, adjusted price earnings 10 times. And yeah, like, to me, I could see this being sort of reasonably good value, but also sort of a counterweight. If you've got stocks where potentially what could happen next month in the budget could damage them, and if there was a crash it could, like, whereas this, I feel, if there was sort of bad times ahead, if there was some rise in unemployment and economic prospects are dismal, blah 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 blah, that that it's the vulture thing, isn't it? And I don't mean that as sort of to be pejorative towards it. It's just, as I say, picking over the bones, cleaning up the desert, keeps it keeps recycles the circle of life back to the other businesses. So you've got to look at it that way. But yeah, I think I like it for the fact that the underlying performance is improving, and I like it because it's counter cyclical. Do I think it could double, triple, quadruple? Probably not. But then it depends on what you want. I mean, if you want something where it's got vast, vast levels of undervaluation, then this isn't the one for you. But if you want something that's sort of steady and, you know getting there steadily, I think this is sort of what I would class this as. So a lower risk, lower reward, but solid, solid business with solid prospects. I don't consider it fair to say that it's consistently low earnings. I think that misses the point. Yeah, and I just say, it's a GARP share, GARP all over. So if you like GARP, growth at a reasonable price, none of this is advice. You make your own investment decisions, as always. But hopefully that's been a useful. I'll publish this in the next couple of days. You get to see it first here on YouTube. So, patience has its own reward. I'm happy to take any questions if there are any, but we're at time, so I'm going to otherwise drop off. And thank you for watching, and much appreciate your support. If you like and subscribe and do all of that, very much appreciate that as always. And thank you for watching. Cheerio for now. Cheerio.